Mostly red on your dashboard here this morning, and you continue to see this follow through from this bond sell-off that really has gone global now. Really started what we saw in the U.S. session with that 7-year bond auction that came out with pretty tepid demand. The European session as well, after we saw German inflation pick up, and you're seeing that really spill over to Asia sovereign bond space here this morning. Take a look at your Aussie 10-year yield. We're up some 7 basis points after yesterday having some of the worst sell-offs in the whole year in the Aussie bond market. JGB yields also ticking higher. We continue to see those declines in this JGB market. And dollar yen, take a look at that. As Dave mentioned, we're at 157.38 levels right now. So basically has eroded all the gains that we saw, if in fact they did intervene last month. So certainly that says something, right? And whether we are getting closer to 160 now and what happens then is certainly another concern for Japan. But we did hear from that BOJ policy board member talking about, this weak yen does mean maybe we might see some more price pressures in inflation, and maybe that does prompt a sooner than expected rate hike. That certainly helped the yen stay a bit stronger briefly here, but we're still talking about around 157 levels here right now. U.S. futures are slightly down, about 0.4%. It's actually not quite down. It's actually down quite a bit during the Asia session as well. The Nasdaq saw one of the worst sort of sessions we've seen in a year also. So it's basically the reaction function is to sell bonds as well as to sell stocks, because we basically have seen now this concern is not really so much in the bond market about inflation, but really what happens with this budget deficit and the like. And is that going to mean higher yields at a time when the Fed is not in a rush to cut rates as well? We talk about these yen pairs. We mentioned yesterday, you guys, about sterling yen. We're watching euro yen now. We're approaching very close to actually those record level highs for euro against the Japanese currency. We're just around that 200 level for sterling yen. And we're watching, of course, the rest of these yen pairs here, but all seeing at least today a little bit more strength coming through for the yen this morning. In terms of what we're seeing when it comes to China, obviously the renminbi is one of concern after the onshore rate. We hit with the weakest level since November. We're still seeing a bit of a back foot here when it comes to China futures here this morning. 727.21 for the offshore rate here right now. But we're approaching the end of May, Dave, where, we thought April was bad for the renminbi. We're getting to worse when it comes to this month. And when we've seen broad dollar weakness, it really hasn't benefited the currency in China at all.
No, in fact, it has sold off in May, as they say. And really, we're looking at the fix of the day. It should be out in about 10 minutes or so, right? So the reason we bring that up is, yesterday's at 711.06 was already the weakest of the year. And do we get even more weakness, or are we at a point, and Yvonne is pointing out, that the PBOC might need to stand fast, as they say, along the currency markets as well? Right. Now, very quickly, so along the yuan weakness, too, so we're also very close, and just to mention, too, so we're down about 9% now in the HS Tech index from the peak, which effectively puts a correction in sight, a technical correction. That level specifically is at 37.21 on the Hang Seng Tech Index. Watch it very closely. Futures are pointing lower as well. And, of course, also happening right now in Beijing, of course, China is hosting Arab leaders. They're watching for any lines, of course, coming through out of the Chinese president. And, of course, in briefings today out of the Ministry of Defense and also the Ministry of Commerce. Right. Now back to the big market story here as well. And as Yvonne, you were pointing out here, of course, the strong dollar story is coming in. And we still have to look ahead, of course, to this inflation print out of the U.S.
Yeah, I mean, that's still a big one for this Friday, right? So certainly we're still dealing with some milestones and at least some event risks to what to expect here in markets today. Let's bring in Mary Nicola. She's our MLI strategist joining us out of Singapore. I'll start with sort of this question of the day, Mary, maybe of where this yen is going, right? It looks like we're getting closer to 160 now. And brings us back to those intervention risks. What is your team looking at in particular?
Yeah, I think one of the key things here for today is just how much traders test that resolve on 160, because that's the last time we see suspected intervention was when yen touched the 160 level. We could see that yet again. Obviously, the uptick in yields globally has obviously had an impact on dollar yen, and that's likely to continue, especially heading into the PCE numbers, as you mentioned. And then some of the other data that's coming out that's implying that there's some stagflationary risks in the U.S. from the Fed Beige Book, but also we're getting the path of inflation globally, whether from Australia or from Germany, is not that straightforward. So that's putting upward pressure on yields, and that's going to likely put pressure on the yen as well.
Mary, and on the equity market side of things, here in Asia, as we know, of course, we're looking at some sort of a downtrend. I think the benchmark, we're down 7 in the last 8 sessions. The U.S. not to that extent, but it seems like equity markets globally have sort of hit a wall of consolidation this week. What do you think is behind that?
Yeah, I think actually a large part of it has to do with yields. I think there's a connection there where the higher yields are stoking this concern more broadly to investors, not only to bond investors, but of course also to equity investors. And the fact that yields are going to stay higher for longer, or the fact that because of inflation is having an impact on equity markets. And yes, you might not be seeing it as dramatic, let's say, in the U.S., but you are seeing it very evidently in Asia, and that's obviously going to take a lot of notice in what's happening in the U.S. bond markets and, of course, with the dollar.
Mary, thank you so much. Mary Nicola there, our MLive strategist, just getting us warmed up here for the Thursday session ahead. We're just about 23 minutes away from the opening bell. Well, it's still ahead. We'll take you straight back. Also in Singapore is the Citi Macro Pan-Asia Investor Conference taking place there, of course, for a deep dive into China's economic policies with Citi advisor David Lubin, of course. There we go. And looking at AI.
And we're still going to be in Singapore.
Yeah.
AI is a key focus at the major tech summit in Singapore today. Our very own Annabelle Jewelers is there live for us. Belle.
Thanks, Yvonne. Yeah, really busy. A couple of interviews coming up in the hours ahead, but this one coming up in particular is of great interest because we're going to be speaking with the FCC. Now, this is the US agency. It pretty much regulates anything that's communications based in the US as well. The focus of this interview, well, there's lots of different talking points. There's a couple of deals that have gone through that could perhaps sort of attract some level of regulatory scrutiny. That's T-Mobile and US Cellular that I'm talking about. There's greater focus and criticism perhaps of Huawei in particular. So it's that US-China connection. That's very much a focus as well. And of course that countdown to the US election in November and that risk perhaps that AI could be used to misinform, disinform as well in voters that are heading to the polls. So great lineup in the hours ahead. But as we said, speaking with the US FCC this hour. Plenty more coming up. This is Bloomberg.
Good Thursday morning. Welcome back. You're watching the China Show. We're just a couple of minutes away from the reference rate of the day. This one is going to be fairly consequential. Well, obviously depends what they do. Could move markets, could move EMs. The reason we say that as well is the renminbi. So we're looking at a chart here of you have the midpoint, which is in white. You have the trading bands, 2% either side, of course, of that midpoint. You have the offshore currency in yellow, which has now ventured beyond where that upper limit is on the onshore rate, which is your line in blue. And we're very close now on the renminbi to hitting the weak end of the trading band. In fact, just another way of looking at this, it's a 2% spread, of course, from the midpoint up and down. The next chart actually shows you this and how close we actually are to that specific level. So the last time we actually hit 2% was back in late April. That was April 26. We're extremely close at this point in time. And the reason this fix will be fairly consequential is if we do get one that is on the stronger side, say, of 7-11, I'm just putting out rough lines in the sand here, that effectively, Yvonne, pulls in where you are in the trading, the 2% trading band limit, and effectively freezes, if that does happen, freezes the currency, the onshore currency, at around these levels. And that could provide a boost really for EM markets, which frankly, if you look at price action today, they need a boost today.
Yeah, I mean, a good post from the MLive blogs about how influential the renminbi is when it comes to the whole carry trade. among EMs as well. That's certainly one thing we'll be discussing as well. Let's head to the Citi Macro Pan Asia Investor Conference now in Singapore, where we're joined by our next guest. David Lubin is a Citi advisor and a senior research fellow at Chatham House. David, it's great to have you here. Certainly, we can start off with the current Chinese currency, and obviously we haven't seen a month like this where, despite the broad dollar weakness, we are still seeing renminbi that is weakening, and maybe it does show that this is more about Chinese fundamentals now than a stronger dollar story. What is your take overall of the economy now in China?
I think the pressure the renminbi is under says more about the US in a way than it does about China itself. The most reliable guide to the near-term renminbi is the US-China interest rate differential. And since the market's expectation is that US rates are higher for longer, that puts pressure on that interest rate differential and therefore sucks capital out of China towards the US. So it's really the sense in which tightening US monetary policy and the expectation that US monetary policy remains tight act as a kind of magnet for capital flows from the rest of the world, which is why it's not just the renminbi, but other emerging economy currencies and the yen that are all under pressure. In fact, it's possible to argue that in the last few weeks, we've seen slightly better news out of the Chinese economy, starting with the April Politburo meeting, which committed to providing more support for the housing market, allowing for central bank funding of state-owned banks and local governments to scoop up unsold property, easing housing purchase restrictions across a number of cities in China. And indeed, industrial production figures for April show, for the first time since May 2022, that the growth rate of industrial production of private companies in China is outstripping the growth rate of state-owned companies. So there's actually some reasonably good news taking place in China, which slightly sort of flies in the face of the news coming from the foreign exchange market.
Yeah, and David, to your point, do you think authorities have a reason to step in? Should they step in and stabilize, or is actually a weak currency doing China some favors right now, particularly around the export story too?
I would say that allowing the nominal exchange rate, the dollar exchange rate, say, to weaken doesn't really do much for Chinese exports, particularly against the background where in the last couple of years, the real effective exchange rate of the renminbi, in other words, the trade-weighted, inflation-adjusted exchange rate, has already depreciated by around 15%. So Chinese exports are already super competitive, and so they don't need additional exchange rate support from that point of view. There is one sense, though, in which a weaker exchange rate might be convenient for the Chinese authorities, which is that, on balance, a weaker nominal exchange rate might help to ease the threat of deflation in China. In other words, to the extent that a weaker nominal exchange rate helps to raise the domestic price level in China, that may help to kind of deal with the deflation problem that China's kind of flirting with.
Yeah, I was about to ask about the inflation part of the conversation. David, just hold on just very quickly here. So we had the reference rate of the day out, 7.1111 against the U.S. dollar. That's the sort of playground and the sort of parameters of the playground today. David, let me bring you back in on the conversation around inflation. Do you think the lack of inflation in China, is that something you think authorities have a toolbox to effectively stimulate and get themselves out of this current hole, David?
I think it's very tough. By far the most reliable tool to kind of allow the Chinese economy to exit this deflation trap would be substantial fiscal loosening. But for all sorts of reasons, the Chinese authorities are really quite reluctant to deliver that fiscal loosening. One reason is that philosophically they are just against what they call welfareism. They don't like the idea of handing out money to households for doing nothing. Partly because their idea is that once you start handing out cash, it's difficult to bring it back, and so it's a sort of slippery path to unstable public finances, and maintaining stable public finances is a big priority for the Chinese authorities. But there's also a kind of behavioral factor behind their unwillingness to deliver a massive fiscal support, which is the idea that they don't want a kind of a culture of dependence. They don't want, the Chinese authorities want to make sure that Chinese households remain nimble and robust and don't become, if you like, lazy. in the way that Xi Jinping once described Latin American countries for their tendency to rely on fiscal handouts. So there's both a kind of fiscal or financial stability aspect to China's unwillingness to stimulate, but also a kind of behavioral aspect as well.
Yeah, you mentioned financial stability, and it's interesting, when you're seeing, I want to broaden it out to what we're seeing in the global economy, particularly in the U.S., where you're starting to see disinflation stall a bit, maybe in parts of Europe as well. You're starting to see PMIs that are still resiliently strong. I mean, is there a cost to this sort of robust growth that we're seeing in the world?
Yes, I think that's right. I mean, the good news is, as you say, we've had 3 consecutive months of global manufacturing PMIs above 50. So there is a sense in which the long manufacturing recession that the world was under during the course of 2023 is coming to an end. But at the same time, global commodity price inflation is now becoming a threat to CPI. A major contributor to the disinflation process in 2023 and early 2024, in advanced economies certainly, was the fact that global commodity prices have experienced negative growth. In other words, there's been deflation in global commodity prices during the course of 2023 and early 2024. According at least to the World Bank's commodity price index, in April 2024, we had the first month of positive inflation in global commodity prices since late 2022. And as goods, and the price of goods inflation starts to increase, then the threat to CPI becomes more evident. And so global CPI, or at least advanced economy CPI, is more likely to be threatened upwards by this revival of global commodity prices, which in turn, I guess, is to some extent a function of this global manufacturing revival.
Yeah, David, we were speaking with Olivier Blanchard the other day, and he was of the same view that almost nothing that's brought inflation down was because of tighter monetary policy. Do you think monetary policy officials, particularly at the Fed, should be tempted to tighten policy even further if that's the case? And separately, do you think Fed rates are restrictive enough at this point in time to bring to get us that last mile down on inflation?
I think it's worth being patient at this stage. Real interest rates in the United States are relatively high by historical standards. And because we have evidence at the moment that the labor market is softening, I would imagine that it makes sense for the Fed to pause, not rush in either to hikes or cuts, in order to see whether this apparent weakness in the labor market and the weakness of retail sales, for example, starts to kind of feed through into inflation expectations. In other words, it's worth waiting for some time in order to see whether economic weakness in the United States can do the job of monetary policy, or can assist the job of monetary policy by easing inflationary pressures in the near term.
David, fantastic insights. It's an understatement. Thank you so much for your time. David Lubin there, Citi Advisor and Senior Research Fellow at Chatham House. Going into the open today, just under 9 minutes away. The dollar is stronger, bottom of your screens, and equity markets, broad weakness across the region. Plenty more ahead. This is The China Show.
Some big corporate stories that we're following for you today. A Chinese court has dismissed a case filed by a local consumer against Apple over commission fees for purchases via its app store. An unpublished verdict seen by Bloomberg, the Shanghai Intellectual Property Court ruled that Apple has not abused its status despite dominating the marketplace. Apple is defending its app store fees on multiple fronts, including in the U.S. and Europe. China's state-backed Silk Road Fund is selling its stake in Italian tire maker Pirelli, valued at around $553 million. Silk Road will sell its 9% holding with price guidance at an 8% discount to Pirelli's last close. Rome has moved to limit the fund's influence over the tire maker, citing national security concerns. Sources say Saudi Arabia is set to launch a secondary offering of shares in oil giant Saudi Aramco that could raise over $10 billion. We're told the sale could happen as soon as Sunday, with informal interest already from investors across the Middle East and Europe. Proceeds will fund initiatives to diversify the Saudi economy away from oil.
Okay, going into the open today, a weakness across these markets, 0.3% to the downside here. The level to watch is at the bottom of your screens on the HS Tech Index, so just about 30 points from that level, from current levels. So I would imagine, the question is, do we get a further 1% down from current levels? If you see the possibility of yields globally over the next, 7 hours of melting up even further, then probably you could make a case that we are seriously at risk of entering a correction today. Otherwise, might just be a typical down day. All that being said, that we are down 7 days in the last 8 in Hong Kong and also across the region. A couple of stocks to watch here on your screens, XPeng, and of course conversations around, and Reuters, I believe, reporting this, that some of these tariffs are part of the conversation today as far as Europe is concerned here. There's also, and we're also looking at some of these solar stocks as well. Yeah. So China actually came out with their current projections on the reductions of emissions this year, 2024. We'll talk more about that in a moment. Logan Group, there we go, on your screens as well. And the company is said to be engaging it's tapping the bankers in the financial markets here in terms of just this being able to refinance some of these loans as well for the company.
Yeah, and that $8 billion restructuring, they say, really hinges on that loan that they might get to for that luxury tower. So certainly that's one to watch, unchanged in the pre-market here right now, but we're still watching the property space, just given what we've been seeing across these down payments being reduced in big tier 1 cities as well. Hang Seng, though, we are lower about a third of 1%, 727 for your offshore rate. Onshore markets are opening up. We'll see how the onshore yuan trades now at those November lows. This is the China Show. The open is next. Welcome back. You're watching the China Show. We're counting on the open of markets here, and it is not just talking about China, but really a sea of red across global markets here this morning. Just really started off in the bond market and the sell-off that we're seeing across fixed income. Yields are continuing to tick up here in the Asia session, and that is starting to feel a little bit of worry when it comes to the equity rallies that we've seen. So consolidation all across the board here. We're seeing a lot of declines in Japan, and it looks like Hong Kong and China also joining in, Dave. Yeah,
we're set to join this parade to the downside right now, and certainly when you look at the fix out of the PBOC, certainly not giving us a reason to expect a backstop from China as far as the EM conversation is concerned here. We're going into the open today. We're down 7 in the last 8 days on the equity markets, whether that's in Hong Kong or across the region here as well. The real pain, as Yvonne is pointing out, is this melt up we're seeing for actually 2 days now when you look at yields. So yesterday, a good example is when you look at yields in Australia. Worst day for Aussie long end bonds this year so far. We're continuing to see that, the JGB yields and dollar yen. More in the macro story a bit later. And perhaps why we're also looking at CGBs, right, as an anchor, this uncorrelated asset to what you're seeing globally. So 10-year yields at 2.3%. We're looking at declines here, 3,600 again. It's been an extremely tight range onshore on price. So actual vols actually come down. Actual volumes have come down even more so. A chart on that in a moment here. Flip the boards, please, if we can. Have a look at where we are in Hong Kong. So this dollar strength story has also pushed up, the Hong Kong dollar to the highest level here in about 3 weeks or so. So at about these levels, at 781 right now, 47 against the U.S. dollar, that takes you actually back to the highest since early May as well. So 3-week low on the Hang Seng Index, and at 37.51, and I think we have that level coming up, bottom of your screens, the level to watch on the Hang Seng Tech Index, below which, if we close below that level today, that puts us into a technical correction on the Hang Seng Tech Index, which is about, I would say, about 30 points from the current levels. Do we have that for our viewers? That's going to fire, I promise you, my producers are not going to let me down. That's going to fire in about 10 seconds or so. Yep, Tencent, HSBC, and Alibaba are seeing some declines right now as well. As promised, CSI 300 volumes also coming through here as well. So we're looking at volumes coming down. You have your 15-day average. So yesterday we actually hit the lowest here, about the lowest since the rally actually started on the CSI 300. So we'll watch this very, very closely. Oh, my producers let me down. There's no... I was waiting. Oh, there we go. Thank you so much. There we go. A tease of all the goodness coming up. 37.21. There we go.
Well, it's interesting, right? What's really causing this sort of correction, right? Obviously, we've seen a lot of these big tech firms like Tencent, Alibaba slashing AI prices. You also are talking about, rising geopolitical tensions with China and the G7 as well. That's really starting to hit some of these large caps as well. So certainly, we'll continue to watch, of course, whether we do enter into that technical correction or not. Let's get more insights from our Asia equities reporter, Charlotte Yang. Now she's with us. It's interesting, despite all this sort of red that we're seeing in markets, Morgan Stanley had a pretty interesting note about being less bearish about China now. In particular, it's because we're seeing a lot of buybacks.
Yeah, so the Morgan Stanley Investment Management, this New York-based firm, was 1.5 trillion under asset management. They're actually, adding Chinese equity exposure on cautious optimism, boosted by stock buybacks. They've seen in the nation, after we had this official campaign talking about how you really need to boost investor returns with more dividends and more buybacks. And so this asset manager, they've largely avoiding Chinese equities over the past few years due to a lot of the structural issues with the economy. So, but lately, they have reducing that, underweight on China because of that. And they believe that with the increasing shareholder return along with valuations, actually stock prices could continue to rise. And they've also linked that campaign with the corporate reforms we've seen in Japan and Korea, which has been helpful to the respective equity markets.
So it's SOEs and dividends have also done very well as a strategy.
Yeah.
Yeah, so dividend stocks have been emerging as a winner in the equities market. So we're actually seeing that again tracking dividend stocks in China outperforming the benchmark CSI by more than triple. And an analysis by Bloomberg Intelligence found that the MSCI China Index, those companies that have a dividend, factor, have actually outperforming the benchmark by more than 35 percentage points over the past 3 years, and that's better than the other factors such as value or like EPS. And then and also it's very interesting that there's also expectation that the yields, which now could continue to rise for more than 5%, which is outperforming some of the more than double the 10-year government bonds, as well as some of the rental yields products in China. So I think there's also a lot of the optimism from investors of running into those dividend stocks as well, because the yields are just better than the others.
Okay, what else are you watching? What else is the team watching today?
Yeah, I think for today we're watching the EV space as well, because there's a Reuters report talking about how the the EU tariffs that was expected to have the next deadline on June 5th, and that could be put off a bit later. And also definitely the Hang Seng Tech Index, we're seeing close to a correction of 10 percentage points, I think, right now. So that's definitely what we're watching today.
Fantastic, Charlotte. Thank you so much, Charlotte Yang there. Out of our Asia equities team. Now on to tech and earnings here. So Didi came out with earnings late yesterday in Asia. So net loss widening in the March quarter as higher marketing costs and also losses in its speaking of EV here, in EV maker XPeng outweighed this revenue boost. Let's bring in Sarah Zhang, our China tech reporter, to talk us through, of course, what was behind, really more context on what was behind this loss.
Yeah, it was definitely more of a mixed bag this time. We saw that their sales were up 15%, but actually the net loss did widen, like you mentioned, from the year before, and that's primarily because of their stake in the EV maker XPeng. If we remember from last year, last August, they made a deal with XPeng to sell their smart car development arm, and as part of that, they got a 3.25% stake in XPeng that obviously lost a lot of market value in the past quarter, so that weighed really heavily on their net profit.
Overall, though, I mean, this is a company that's still dealing with a lot of transitions, right? Whether it's at the top of management, also whether they are going to list in Hong Kong. What do we know about those things so far?
Exactly. I think those are the two big questions that investors are wanting to know more about right now. So we saw that the co-founder, Jean Liu, she stepped down from her president and board director roles after almost a decade in those roles. And the CFO, Alan Zhuo, he stepped up to that board position. Now Jean is in sort of a permanent partner position. We're not really sure what that will mean for the company going forward. As for the IPO, we're looking for clues. Are they going to be able to relist this year as they've been planning in Hong Kong? Will they get the kind of valuation they want? Will regulators okay that? Those are all questions that we want to know the answers to.
Well, Hyundai's global COO is confident in the automaker's bet on growing U.S. demand for electric vehicles while still investing in hybrids. We spoke exclusively with Jose Munoz, who also gave an update on the progress of Hyundai's new Georgia EV plant.
Well, we are still very confident, and I was visiting our plant in Savannah last week, and I'm happy to report that we'll be able to produce 3 months ahead of schedule. So by October this year, we will start producing our very popular Ioniq 5. So I think that's great. We're very confident. And then, as I've said many times, we continue to double down on our bet for electrification, and we're happy to continue with that. So your question about the hybrid, we've also seen that the evolution of EV sales in the industry may be not as fast as everybody expected or as the regulation would expect. And then we have seen also that a number of consumers are betting for maybe alternative fuel types beyond ICE, like hybrids and plug-in hybrids. And that's why we have decided that in our plant in Savannah, we're going to produce also hybrid vehicles. This is going to imply, of course, an increase on investment, but we believe is needed. And we are very happy to see the reaction of our dealers and our stakeholders as we have announced that.
Is the Ioniq 5, by the way, great to see you as well, Jose. The Ioniq 5N hit the market, wowing a lot of people with the sort of ICE emulation and sporty performance. Is that thing sold out already? I mean, what are the orders looking like for that?
Well, Ioniq 5N is unbelievable. I think the few journalists like you, Matt, know really what this car can do. It's more than 640 horsepower. He just made it to the Performance Car of the Year in the World Car event that took place in New York in April. And this is only after 2 years earlier, the Ioniq 5 became World Car of the Year, EV Car of the Year, and Design EV Car of the Year. I think this is one of the few cars that could race you in one of your motorcycles and beat you. But then I'll leave it to an opportunity in the future.
I look forward to it, Jose. Listen, the price tag continues to get higher as these cars gain popularity with consumers. Obviously, the Ioniq has done well. This one costs, I think, north of $65,000. And the Genesis product is doing so well that you're able to take more price there. Do you see that power increasing even as it's falling for your competitors?
Well, we really do see the power increasing. So we really believe that the future is going to be electric. So it's not a matter of if, but when. If you go to Europe, I think there is about a 20% mix of EVs. You go to other regions like China, it's about 30%. We are stable in the United States, about 8%. But in our case, we continue to do very well. This year to date, we have increased our sales of EVs by more than 50%. And last year, we doubled our sales of EVs.
Jose Munoz there, the global CEO of Hyundai, speaking exclusively with our colleague, of course, there, Matt Miller. Right, from there, we'll take you straight back to Singapore, where the Asia Tech X Summit is taking place. And, of course, our colleague Belle is standing by there with our next big guest. Belle.
Thanks, Dave. Yeah, well, I'm really pleased to say that we're joined here this morning by the Federal Communications Commission Chairwoman. This is Jessica Rosenworcel. And Jessica, I just want to start off by saying, for people that are unfamiliar perhaps with the US FCC, this is the sort of agency that oversees all communications in the US. So you're in Asia. It's quite a whistle-stop tour, but you were just telling me that a lot of your counterparts in the ASEAN region are converging here at this summit. What's the sort of main message and what's the main themes of the conversations that you're having here?
Well, there's a digital transformation that's happening worldwide, and it's affecting small and big countries alike. So this is a terrific opportunity to talk with other countries in their backyard.
In their backyard, what are the sort of main risks that you're seeing here? Because, of course, there's been quite a level of scrutiny that we've seen from the US FCC on the likes of China's Huawei, for instance. Is that coming up in the conversations that you're having?
Well, we're talking about network security, of course, but we're also talking about how to make sure broadband and internet access reaches every one of our citizens. And we're having early discussions about artificial intelligence, and that's really important.
And what are the themes of the conversations that you're having around AI in particular?
Well, I think at this point we want to share our intelligence, what we're seeing happen in our own borders. And it's really important to me that we not just talk doom and gloom about this technology, but that we find optimistic uses for it and include that in the conversation as well.
What are you seeing on AI within your own borders?
Well, we're seeing a lot of interest and a lot of investment. I think there are some creative uses that are emerging that are going to change our economies, but there are malicious uses too.
And those malicious ones, what are you focusing in on there?
Well, I think there's a lot of concern about the use of it in political campaigns. And I know at the Federal Communications Commission, we have proposed at a minimum having transparency in advertisements for political campaigns about whether or not AI technology has been used.
Yeah, this is a really big theme, of course, because we're approaching the US election, and that is one of the greatest risks of AI, of course. It's around deep fakes, it's around misinformation, disinformation. Do you think what the FCC is proposing is enough?
Well, I think these are very big challenges, and we're dealing with them not just in the United States, but globally. But it's also important in the United States that we abide by our Constitution. We have a long tradition of the First Amendment, which prevents government from restricting freedom of speech. So that's got impact on how we'll choose to deal with this.
What's been the reception so far then to those proposals?
So those proposals are just out, and my colleagues are taking a look at them back in the United States. But one thing we did last week was we fined someone responsible for an AI voice cloned call that purported to be from President Biden with misinformation about where and when to vote. We tracked down who was responsible, we fined that individual, and we fined the carrier that carried that call.
Okay, but we can shift away perhaps from AI in the election, because the other focus, as we were discussing, is around risk that could be posed by other actors in the system. And one of the things that the FCC is doing right now is investigating how US phones use signals from foreign satellites. So what's the status of that probe?
That investigation is underway, so I don't have new information to share, but all of our phones take in information from global positioning systems, and we want to make sure when it takes in that information, it is secure.
What are you expecting to find in that, though? Because there's been several independent analysts or experts in this field that have said that even if you are taking in information or pings from other satellites, like from China, like from Russia, there's perhaps limited impact from that. Are you expecting to see the same, or are you looking for something else?
Well, it's early days in our investigation, so I can't quite tell you where we're going to wind up. But I think we want to understand these issues better, because remember, those phones, they're in our pockets, our purses, and our palms at all times. We want to know where they're getting information from.
Do you think there's been enough funding then? Because part of the criticism here is that the US has perhaps been slow to deploy new satellites into the system. Do you see that happening as well?
Well, the more GPS satellites you have reaching you on your phone, the more accurate your information will be about global positioning. So there's a lot of value to have updated satellites, and I definitely want to see our Defense Department continue to launch those satellites. I think that's important, not just for defense, but for our economy, which uses those signals too.
What about the deals? Because, of course, it's not just tensions between the US and China that we focus on. Leading up to the US election later this year, we're also seeing greater scrutiny that's being applied to deals like, and not within your purview, or your remit, but say, for instance, Nippon Steel's takeover of US Steel. And another one that could perhaps attract some level of scrutiny is Sony's bid for Paramount's assets in combination with Apollo. What's your view on that deal?
Well, I can't talk to any specifics about deals that are not before us right now, but we'll take a look at the facts if anything comes before my agency.
All right, Jessica Rosenworcel there. Thanks very much for your time. That was Jessica Rosenworcel, the Federal Communications Chairman from the US. Yvonne.
All right, great stuff, Belle. Thanks so much. And more coming up from the Asia Tech Summit in Singapore. We're speaking live with the Communications and Information Minister, Junal Puthucheary there. This is Bloomberg. Well, Chinese President Xi Jinping is meeting with Arab leaders this week as Beijing seeks deeper ties in the region. For more, let's get to our China economy editor, James Mager, with the latest on really what's on the agenda this time around. James.
Good morning. I think obviously the first thing that's going to be on the agenda is the conflict in Gaza and the effects that's having in the broader region. China's not a direct party to that in the ways that America is, or the countries that have come for the summit. But it is having an effect on Chinese exports. Shipping costs are rising because of the continued attacks in the Red Sea. They're forcing ships to reroute around that. And China has said that they want to see an end to the conflict in Gaza, both for humanitarian reasons and also because it's having those kind of economic spillovers. So I think that's going to be the first item on the agenda. Though China's ability to actually change the situation on the ground is quite limited. The other things that they want to discuss, they're going to discuss is further economic cooperation. There's been a slew of announcements of Chinese investment into the Middle East, into Saudi Arabia. There's a lot of money going to the United Arab Emirates for various different projects, and so that investment and trade is also going to be quite high on the agenda. And those countries are very much welcoming Chinese investment, not in the sense of this is a way of separating themselves from the U.S. But I think a lot of countries around the world are looking at the China-U.S. conflict or the China-U.S. sort of rivalry right now and saying we can play these two off against each other. We can get money from the U.S. We can get investment from the U.S. like the deal recently that Microsoft did to invest more into Saudi Arabia. But we can also get money from China. And so it's beneficial for many countries around the world to sort of play off the two superpowers and see what they can get out of that rivalry. So I think those are the main topics that we're going to see discussed today.
James, do we have any more information on the potential deals that may get announced? I mean, to your point, right, when we get these very high-level summits taking place and political leaders gathered in one place, typically in the side rooms and these side conversations are these business leaders trying to hammer out some deals. If you could just maybe give us more context if you have any information.
I don't have any information about new deals. I mean, obviously at these things, there's always a high-level announcement, and signing to memorandums of understanding on various different sectors. I think we'll probably see something similar today. I was just at the signing ceremony a few days ago for the president of Equatorial Guinea, where again there was a number of these memorandums of understanding that were signed on cooperation, and so I think we'll see a lot of those kind of high-level things. I think if there is real deals and real money changing hands due to this summit, those deals aren't going to come out this week, but they will sort of dribble out over the next weeks and months as the companies involved actually do their due diligence and finalize whatever deals they're talking about. But I think you can expect further investment into for example Saudi Aramco, further investment into China, but also further Chinese investment into the petrochemical processing sector in Saudi Arabia. I think those are the kind of things that we might see.
James Mager there, our China economy editor, on the latest here from this year's China-Arab Summit. And we're just getting a line here out of the Chinese president that already China will be hosting the 2026 version of that event. Right. The short story on markets is everything is down with metals. So we'll see whether this changes or not. Equity markets are down. Bonds are still feeling the pain. FX markets, the contrast to the US dollar, South Korean won is down about 0.75%, the Taiwan dollar. You go effectively down the list. What you don't see, what might be a big story moving forward, is where we go with the Japanese currency. More on that story and a lot more on the way in the next hour of the China Show. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300, just a half hour into the session. It looks like we're getting a little bit more traction to the upside here, and take a look at that. You're seeing a little bit more of that rotation, or at least reversal, in the HS tech space as well. We were talking about entering into that technical correction. Looks like we might, Dave, avoid that today.
Yeah, it's quite a reversal we're seeing. Although there doesn't seem to be any indication that we're entering a new sort of trading range to the upside. Right? We have been consolidating at these levels here. So 3620 on the CSI, we're at 3800 in the Hang Seng Tech Index, so we're still ways away in terms of the highs that we hit a couple of weeks back. In fact, just to your point, right, the HS Tech Index, we were on watch for a correction, right? So
we're still bucking the trend, though, today.
Yes, overall, against the backdrop of weakness across the region. Now, all that being said, perhaps your biggest market story today, away from these Chinese markets, is this melt-up still we're seeing across DM bond yields, right? So there we go on your screens. Everything, all your tens effectively here, with the exception of China, which is, of course, uncorrelated asset, as they say, of course, in this group. So we're now trading we're 110 right now, is very much in focus on the Japanese 10-year yield. That's a new 2011 high on that. The Kiwi dollar, we should be getting the budget. There we go, bottom of your screens, and also the 10-year yield in Australia. We're coming off a CPI print, which was on the hotter side of things yesterday. Not to mention this move away from duration yesterday, the last 2 days or so, 2 days of bear flattening on the yield curve, bear steepening rather, on the yield curve. And, bear flattening. Okay, I'm just getting my terminology mixed up. And also going into the CPI report, right? So where are we on this conversation around the Fed cutting rates? Effectively, I'll put it very bluntly, the commentary coming through this week, and I'll bring your attention to the comments coming out of Neil Kashkari yesterday, that he said informally, Fed officials, most of them, if not all, have not taken a rate hike off the table as far as their... if the data merits that, they will respond. Either way, if the data starts to come in, then they will, of course, bring those cuts back.
Yeah. You heard from just now David Lubin saying, no, maybe it's time to be a bit of patience about this whole situation. Maybe we shouldn't jump the gun about maybe, we could still see rate hikes, but certainly it seems like rate cuts have been delayed, if not derailed, right? That seems to be a lot of commentary that we've been hearing so far. But today, it seems like it's not really about an inflation concern, though. I mean, it's really what we saw in these bond auctions, these concerns about U.S. deficits that maybe could drive yields higher, more so than really the inflation picture itself. But then we still have that PCA gauge to deal with on Friday tomorrow.
Yeah, and hopefully that does not add to the list of woes in this market. And of course, when you look at dollar yen, which is the top row on the rightmost side, 157.45, which effectively takes that exchange rate back to levels where we did have suspected intervention. It's still suspected, right?
Yes. I think tomorrow, is it the last day that we're supposed to find out if in fact they did?
The Ministry of Finance is going to release.
But does it even matter at this point, because you basically have erased all the gains that came from the apparent intervention a few weeks ago.
Yeah, we're back there. I was joking yesterday with Mary Nicola so you have this rate differential in Japan. Yeah. And then they're doing this at the margin, right? Yeah. It's like taking 3 bottles of tequila and then taking half an Advil and thinking things are going to be okay. Yeah. Right? You know, do more of an offset. Global equities have done exceptionally well, though, this year going into this week on consolidation. Joining us here on set, Thomas Rupf, Asia Chief Investment Officer at VP Bank. Good morning, and thanks for coming in, and thanks for staying and listening to our banter just there. Why have global equities done very well and held up despite all the bad news that Yvonne and I just laid out there?
Well, it's mainly 2 parts, I would say. First one, clearly, earnings hold up very well. That's also, and the second one clearly was on the U.S. side with growth coming in better than expected. So basically 6 months ago, we were still talking about recession. That has also changed, that we have also better growth. At the same time, we also see it on a global level, manufacturing coming coming better, which has also supported the equity story there, which is why we have seen a very strong performance, especially in the U.S. over the last few months.
Are you concerned at all by this rise up in yields in the bond markets now? Is that going to impact equities in any way?
Well,
we're seeing these wobbles.
Yields always impact the equity markets, but I think what's important for us, especially over the last few days, it's all about interest rates. Also there we take one step back. So basically for us, the disinflation trend is still our base case. So we expect rates to cut by end of this year. And we should also not forget that we have now 1 week of slightly better news on the macro side, but we had 4 weeks more negative news. And that's why we are more looking forward for next week's job market if we still see further weakness in there for inflation to slightly come down towards the end of the year.
Are you expecting this U.S. equity market to just keep going until we're told otherwise, effectively?
Within the equity landscape, we are currently underweight U.S. equities. So from a valuation point of view, we see it is at elevated levels. We see better opportunities out there. That's also one reason why we have an overweight in emerging markets. At the same time, we have also reduced our underweight in Europe to neutral, as we see also growth picking up and also better valuations. That's why we have been maneuvering within the equity landscape.
Rate cuts are coming in next week. I mean, the ECB is effectively expected to cut rates. How much does that go into that decision to raise Europe from underweight?
Well, that was one of the considerations, but the more important one was really the surprise on the GDP growth, where we have seen even the sick man of Europe, Germany, growing at 0.2%. At the same time, we have seen the same with France, the southern states still holding up much better. So there you really have Spain and Portugal leading the race with 0.7% GDP growth. So also there over the summer month, we expect that to also continue, especially as we'll also benefit from tourism during the summer months.
Okay, you mentioned EM. You're looking a little bit more positively. Is China fitting into that as well, just given the rally we've seen so far?
China feeds into that, so that's also where we have increased our overweight within emerging markets in mid of March. And we have just reiterated also that we still believe the recovery has legs, and that's also where we see more potential there. But of course, it's never a straight line. That's also where we also expect a consolidation, and that's also where the underlying picture has clearly changed with supportive measures coming in from the policy side, and especially the willingness to do something. I think that's really what has really changed, and the recovery is ongoing. In China.
What exposure do you have in China right now, specifically?
Well, with an EM, an overweight in China itself, exposure-wise itself, it's a tactical overweight. So also what's important there, the long-term structural story that still needs to be solved with demographics, with debt. But short-term, over the next few months, we are still positive in China.
I think the debate is largely still China's still a tactical trade more than anything else. Do you subscribe to that view, or do you think we're slowly moving into a part where this goes beyond tactical at this point in time? That China is in fact back.
Well, for us at the moment, we still for us it's still a tactical trade for now. So that's also where we still need to see more measures, especially on the consumer side, especially the consumer really getting into it, and the properties, that's also what needs time, right? That's what we have seen also in Spain in 2008, in the US, that takes years to solve. So at least we believe we have seen now the bottom coming in, also with the policy measures coming in, and also more expected during the July plenum.
Okay, where else are you looking around in terms of the equity space then? I mean, we mentioned a little bit of Europe. I mean, obviously in this part of the world, Japan is still something that continues to be maybe a longer trend story versus tactical. I mean, how are you looking at Japan too now?
For Japan, we currently have a neutral weight. So for us, it has a space in the asset allocation. For sure, long-term story, we still believe it is going to play out, and especially the process coming out from the deflation into inflation, that's also where we see it takes time. That's also why Abenomics took more than 10 years to get there. That's also where, but we see the corporates getting more profitable. At the same time, we have seen the wage growth. That's also where we are a bit more optimistic, despite for sure we have seen now also some news that the consumer is still not fully buying into the story, but we believe that it just takes more time, and it still has its place in the asset allocation.
And what about income, for example, or fixed income to be more exact? And how are you looking at fixed income stacked against cash, given that the yield curve is still pretty much inverted? Like what value do you think there is in fixed income, for example?
There is value in fixed income. So for us, we are currently overweight fixed income over equities. We still see kind of the yields. For sure, we have now the story with yields coming higher again, but we'll still believe that it's kind of more or less kept to the top side, that there's really a high level of resistance to really increase rates. And we also expect that it's a good opportunity to get into fixed income, but it's still high quality, which counts. And within high yield, it's more the short duration tenor, 2 to 3 years tenor, which we look at, where you still get compensated with an inverse yield curve, getting high yields at the same time. Corporates still being at a better position with a better growth across.
Okay.
Thomas? Thank you, Thomas Rupf there, Chief Investment Officer for Asia at VP Bank, joining us here in our Hong Kong studio. Still ahead, BHP walks away from its $49 billion bid for Anglo, marking an end to a 5-week battle between two of mining's biggest names. We have details coming up. Yeah, and we'll just take you straight back here, of course, to New Zealand, where the government is
presenting its first budget, and a couple of lines coming through as well. And by the way, you're looking at, conversations there. We had the finance minister in the room there, of course, delivering the budget speech there. A couple of things. You have tax cuts in focus, plus, of course, other things. Let me just get you the more pertinent lines as we speak. So tax cuts in the order of about 15 billion, that's Kiwi dollars, over the course of the next 4 years. That's point number one. Budget deficits, 13.4, 2024 to 2025. And you're also looking at an increased bond program of about 12 billion Kiwi, also over 4 years. In terms of the outlook for the economy and government revenue, weaker economy means less tax revenue. Kiwi assets right sort of your screens, plenty more ahead. This is the China Show. Welcome back. You're watching the China Show. This is a live look at, of course, what's actually this week has become fairly cooler on the mercury side of things. Of course, it's come down ever so slightly. It's become a lot more windy, and maybe the clouds on the horizon are signaling something might be upon us right now. 0.3 of 1%, 18.5 right now, Hang Seng Index. Dollar China slightly to the downside, so some strength coming through. Although when you take a look at this, over that 72-hour period, it's really been quite a big move up in just dollar against not just the renminbi, but also against EMFX here.
Yep, we're also watching very closely what's been going on in the courtrooms there. Of course, the Hong Kong 47, the so-called group that was named for the number of defendants that was charged under Beijing's national security law about 2020, a few years ago.
2 years ago.
We are expected to hear a verdict from that about their fate. But of course, a lot of these prominent lawmakers that we've heard from and talked to before, they've been jailed for about 2 years now or more. So we might be learning their fate today.
Yeah,
so that's happening now.
We will be breaking that news to you, of course, once we do get information on that verdict out of the courtroom. In the meantime, though, speaking of Hong Kong, and this really pivots more back to the economy, Link REIT, Link Asset Management, Link REIT you might know even better than Link Asset Management, of course, the company behind the REIT, actually sees challenges ahead for its real estate portfolio as the recovery in Hong Kong and China remains slow. Now, the firm, of course, as we mentioned, runs Hong Kong listed Link REITs, which just reported an 11% annual jump in revenues. Although when you look at net property income, that coming in slightly softer than expectations. The executive director and CEO, George Hongchoy, joined us on shows earlier and spoke to us exclusively.
There's a lot of macro headwinds. Obviously, retail market recovery has been slower in Hong Kong and China. But we have been very lucky to have the assets in Australia and Singapore. Both of those group of assets have done very well. We have also managed our capital and hedging and balance sheets well enough to protect ourselves against interest rate increase.
The Link REIT's Hong Kong retail occupancy was actually quite interesting, a record high of 98% in March. Do you see kind of retail headwinds coming from Shenzhen competition, and what are the strategies to try and maintain this share?
The Shenzhen leakage has been headlined in the media and also a lot of the analyst coverage. We think that it is manageable for us, mostly because we have community shopping centers, really people come for daily necessity. So the portfolio itself has been quite resilient. I think the big picture for Hong Kong, apart from people going to China, what we're lacking is that the government have not reversed the change in the policy to allow people in Shenzhen, for example, to come on a multiple visit visa. And until that policy comes back to reverse to where we were before 2018, where we had the peak in retail and tourist spending, that will take a while for our recovery to come.
Can you give us your views on, I guess what you've seen in terms of this go north trend, right? We're seeing people heading more towards Guangdong province and spending their money there. Has that had a big impact in terms of Hong Kong businesses and retail?
Yeah, it is part of Hong Kong becoming part of Greater Bay Area. It is a desire for the government and the region to integrate more and for people to travel, to become more porous. And as I said, it has been a little bit more one way for us going up and less of people coming down. So I think that's something that we need to encourage the government to change. But otherwise, I mean, this is a long-term development that will continue. As a owner of shopping centers, we need to make sure that there is continuous footfall. The shopping center need to be interesting with the right tenant mix. With that, then shoppers will continue to come. And I think that's a strategy that we have continued over the last many years and continue to protect us with a very high occupancy with a lot of tenants' demand.
Have you done anything to reposition yourself in that regard? Because I know you've also recently bought Vanke's Mall in Shanghai. Would you be looking to take advantage of more opportunities like that, particularly as a number of developers engage in necessary fire sales?
The portfolio remix has continued. We'll continue to look at ways to recycle capital and also to look at interesting assets to acquire. What I mean by interesting is they have to come at the right price. Obviously, we are demanding high return given funding costs have gone up. And to the extent that something like Qibao Vanke Plaza will come along, we'll be very quick to react because we are sitting on a very strong balance sheet relative to a lot of our competitors. We have a team to really be able to deploy and integrate the assets into our portfolio very quickly. So we stand ready to look at different opportunities, and we are, and not just in China, but across the region as well.
George Hongchoy there, Link Asset Management CEO, speaking with us earlier on Daybreak Asia. We just have some breaking lines crossing. We were just talking about that national security trial. We are learning from our colleagues that are at the courtroom right now that the court has found 14 opposition figures guilty in the city's largest yet national security trial. We don't know who they are at this point. Of course, we were talking about there was a total of the so-called Hong Kong 47, including prominent activists like Joshua Wong, former lawmaker Claudia Mo, who were accused of conspiring to subvert state power by holding unofficial primary elections. We might be just waiting for more news on what this means for the rest of the 47 here right now. But certainly this goes to show it is another step where we are in this whole national security legislation, Dave, and I think sentencing is going to be quite telling as well.
Yeah, on top of the actual verdict itself.
Yes.
Might even tell us more, just given the broader context, of course, of these conversations. So, yeah, this is the breaking news out of Hong Kong this hour. We'll get more details on the story in a moment. We'll take a break. On the other side of it, we'll be back with the full story. Plenty more ahead then. This is Bloomberg. Okay, just to get you up to speed here on some stories we're tracking at this point, a Chinese court has dismissed a case filed by a local consumer against Apple over commission fees for purchases via its app stores. So this, in this unpublished verdict seen by Bloomberg, the Shanghai Intellectual Property Court ruled that Apple had not abused its status despite dominating the marketplace. Now, Apple is defending its app store fees on multiple fronts, including in the U.S. and also in Europe. China's state-backed Silk Road Fund is selling its stake in Italian tire maker Pirelli. It's valued at around $553 million US dollars. Now, Silk Road will sell its 9% holding with price guidance at an 8% discount to the company or the stock's last close. Now, Rome has certainly moved to limit the fund's influence over the tire maker, citing national security concerns. Now, Meta Platforms has removed hundreds of Facebook accounts allegedly associated with the covert influence campaigns from countries including China and Israel. Its quarterly threats here reports noted that some AI tools to generate disinformation. Now, Meta also says it found a network from China sharing AI-generated images of fictitious pro-Sikh movements, which is a sensitive issue, of course, for India. Now, China is sending a new pair of pandas to Washington's National Zoo, reversing course after having taken back all the animals on loan to the U.S. Now, the zoo says the pandas will stay through the course all the way through April of 2034 in keeping with past agreements. Now, the bears and any offspring will remain Chinese property. A previous set of pandas left D.C. or Washington back in November after a disagreement, or maybe they overstayed their visa. There we go. Okay, now let's do just an update here, of course, and you're looking at live pictures outside the court, in fact, here in Hong Kong, where the verdict has now come through. So we're talking about the Hong Kong 47. So a total of 47 people, of course, we're looking at verdicts in that. 16 contested the charges, received their verdicts today. And we understand from the 16, of course, 14 had been found guilty.
Yep, here. 2 have been acquitted, is what we're hearing here from this trial right now. We've been talking about the number of people. I mean, there's crowds forming outside. More than 200 members of the public have watched this trial at the court in Western Kowloon. Some have been lying overnight as well. We're hearing some diplomats, including those from the EU, France, and the U.S., were among some foreign representatives observing this hearing as well. So this is what we're hearing here this morning. We'll get you an update coming up with our team that has been watching this trial very closely. In terms of markets here today, we're watching very closely when it comes to the clean energy, the EV space as well. Obviously, there's been a lot of talk about these solar stocks have been very much in focus, but really some of these emission targets and the like that we heard from China. So watching very closely. China also gradually removing some of these NEV purchase restrictions. You're seeing the likes of BYD up some 1% here right now, and we're watching Aussie agriculture stocks as well.
Yeah, on the back of news that China will be lifting imports on beef from Australia. So in many ways, the beef between the two on this specific issue has certainly come down a little bit, and we're looking at some of these names as well on your screens. These are not the Aussie agriculture stocks. Can you flip the boards, please? If we can, there we go. Thank you so much. There we go. We're up 3% on some, and sort of the broader read, of course, is the opposite side of things. Right, we're headed into the Tokyo lunch break. A market update plus an update on this verdict here in Hong Kong ahead. This is the China Show.
More on this breaking news story now. A Hong Kong court has found 14 opposition figures guilty in the city's largest yet national security trial that targeted scores of pro-democracy activists. Let's get to Alan Wan, our China economy and government editor, joining us now with more on this. Alan, I mean, just bring us up to speed what we're hearing so far.
Yeah, so the court has found a majority of those defendants guilty today for subversion-related crimes. They were involved in holding an unofficial primary election looking to win a majority in Hong Kong's legislature, and that was seen as an act to challenge the state's power.
Okay, so what are we watching out for next? So we understand just a backdrop. So 47, 16 decided today, 14 are guilty, 2 acquitted. What's next here?
Yeah, the next interesting thing is this afternoon the judges will explain the reasoning for why they found them guilty. And the 2 people who were found not guilty were the first acquittals since Beijing imposed the NSL on Hong Kong a couple of years ago. Be very keen to see why that is the case. And in a couple of days, in the coming weeks, probably, they also sentence the defendants, and we'll wait to find out how heavy the penalties will be.
Yeah, you mentioned about this is the first time we're seeing acquittals. How significant is that? Does that tell us a little bit more about how severe and how willing the government is in cracking down on national security?
We'll have to wait to see what the judge's reasoning is, to be honest. They are the first acquittals because until now, the national security law has had a 100% conviction rate.
Okay. Yeah, okay, and I guess context there is because 16, so the 16 actually contested the charges, and of the 16, of course, 2 actually got won what they wanted.
Yeah.
So you mentioned, so the 31 then, have they pleaded guilty?
Yeah, 31 of them charged have pleaded guilty.
Okay.
They include some prominent activists like Joshua Wong or former lawmaker Claudia Mo. Usually pleading guilty gets you a lighter sentence.
What were you looking for in the sentencing in particular? How important is that?
Those crimes carry a maximum penalty of life in prison. So it'd be, well, we'll be watching out for how heavy the judges will lay down those sentences.
Okay. Alan, thank you so much. Alan Wong there. Getting us up to speed here. This courtroom, by the way, is quite near where we are here in our central studios in Hong Kong. Our China economy and government editor there. Right, very quickly here across these markets, we're looking at declines here, 0.8% on the regional benchmark here, 0.4% on S&P futures. Just about every single sector is down today. The smelt up in bond yields, the strength we're seeing in the U.S. dollar coming back as well. Asia ex-Japan, 0.7%. The Chinese benchmarks, though, have been bobbing all over the place. We opened actually lower, reversed higher, and then I believe right now we're just really just underwater as well across some of these benchmarks as well.
Yeah,
So
it's a good day. It's a good day to see get a pulse check of where people are investing here right now when everything seems to be a sea of red. Let's get to Endowus. This is a digital wealth platform. They published its first private wealth insights report into high net worth individuals in Hong Kong, also in Singapore. And this is what they found. 62% of respondents in Hong Kong are looking to increase their allocations to private market strategies and hedge funds, so sticking out of public markets for now, while 40% across both markets are willing to take some risks to their capital. Let's get more now from Steffanie Yuen, Managing Director and Head of Hong Kong at Endowus. She joins us now. So key takeaways from all this.
Well, it's very interesting to see some of the differences and the nuances between the two regions, both Singapore and Hong Kong, obviously key wealth hubs of the region. So as we said, overall, we've seen investors, high net worth investors across both regions interested to increase their exposure to alternatives, particularly private markets and hedge funds. But when we drill down into kind of the reasons why they're interested in, it's quite interesting that there are some nuances. For Hong Kong investors, they actually have a stronger preference to increase the allocation. They mentioned the primary reason is to increase diversification and sort of reduce risks in their portfolios. And I think that's kind of understandable because of what we've seen in the Hong Kong-China markets in the past couple of years. It's obviously underperformed global markets, and we all have home bias in our portfolios, right? So Hong Kong investors are looking to kind of, how can I diversify my portfolios more with private markets and hedge funds? Their correlation to public markets are kind of lower. For Singapore investors, quite interesting. Their primary reason of increasing the allocation is actually looking to increase returns. And also they cited they want to make sure their portfolios can make sure that it compensates for the high inflation they've seen in Singapore. So we've seen both markets are interested to increase the allocation, but there's a slight nuance in terms of the reason.
Yeah, the drivers to the same location here. Do we have an idea to what extent they want to increase those allocations to into, let's call it, alternatives?
So as a wealth advisor, and we focus on sort of the affluent segment as well as the early high net worth segment. What we want to proliferate, so our name is called Endowus. It's kind of the endowment investing for individuals. So we're not asking investors to put all your money into private markets or hedge funds, but we're saying according to your investment objectives or risk tolerance, have some allocation to sort of help you achieve your investment goals, whether we talked about diversification or it's increasing your return. So if your risk tolerance is slightly lower, you can look at 10%, 20%. If it's higher, 30%, or we've seen endowment funds go up to 40%, 50%. So it really depends on the person's preference. And I think particularly for alternatives, we always warn our clients, yes, you can harness the illiquid premium, but there are additional risks such as liquidity, as well as longer lockup periods potentially. So it's really important.
Jamie Dimon had an interesting note about private credit. About
if things turn sour.
If things turn sour,
that's a problem.
We've never seen it in bad markets before. Is that something that you're looking at as well? I mean, how closely are high net worth individuals looking at private credit?
So interestingly, with all that interest in private credit, we've seen in the survey as well, private credit stood out to be sort of the most interested asset class for our investors as well. But we're also agree that there is kind of a lot of interest in the market, and when we recommend managers or products to our clients, we make sure we do due diligence on the managers that they really have track records. So we have seen managers that have gone through the GFC. They've track records of 20, 30 years. Newer managers who kind of jump on the bandwagon and just starting new funds because of this new hype, we're a bit more worried. So we as an advisor, we help clients gatekeep and make sure that they don't have to worry about some of these concerns that they have, right? Does the manager have that experience to weather through the cycles, etc.?
Yeah, counterparty risk, really, if you think about it. What is this might be a stupid question, what is the ideal time horizon to get into private markets for high net? Is it 4 years? Because you mentioned illiquidity, right? So how much time do I need not to see my money?
So exactly, definitely if it's rainy day money, no, that's not the right pocket of money. 3 to 5 years, you can potentially look at some more liquid kind of alternatives. And obviously, I think when we recommend to clients, we always think about the most long-term bucket of your money. Okay. But obviously, we understand for individual circumstances could potentially change. So I think one very interesting development in the alternative space is the development of evergreen structures, what we call semi-liquids as well. So obviously, the underlying is still illiquid assets, but managers have set up structures that if individuals need that liquidity, they have that window, whether it's quarterly, whether it's semi-annual, so that in case they need that liquidity, they can still get that. But obviously, as I mentioned, if this is really a short-term bucket, we wouldn't recommend our clients to over-allocate to alternatives. But if you're looking at harnessing sort of long-term retirement bucket, it is something that you could potentially consider, because that's why all the long-term big institutional investors, the pension funds allocate to this segment. It's because you harness the long-term compounding returns of this asset class.
And where within the alternative space are you find the best returns? How does it compare to stocks, bonds, cash right now?
So for us, and I think it shows in the report, I think the biggest benefits for individual investors, it's not necessarily looking at high risk, high rewards, but it's the diversification effect. So we've seen sort of most interest for clients looking at the lower end of the risk spectrum of the alternative products, such as the multi-strategy hedge funds, the likes of the Millennium, Point72, Bally Ashley. So these hedge funds, they are targeting kind of very reasonable 10% per annum, but they're very focused on downside protection. So again, going back to what I mentioned, a lot of Asian investors have seen kind of volatilities in China, Hong Kong markets recently. They're very concerned, how can I protect the downside? And these kind of alternative products, especially some subsegment, can help them provide that diversification. We talked about private credit, obviously harnessing the high interest rates. So we've seen a lot of interest in that kind of diversifier, not necessarily the higher risk, the fees, those, because again, those you really need long-term horizons, and we want to educate our clients more. But we've seen sort of the primary sort of objective, not necessarily juice up your returns by 10 times, but more to make your portfolios more resilient.
And do you suspect, and this certainly throws the story forward, do you suspect they will still feel the same if and when, and we're seeing the rally already starting here in China, and when rates come down too, do you suspect this
trend to continue?
This trend will remain calcified around private markets?
So if you asked me last year, and if the rally began last year, maybe my answer would be different. But I think interestingly, the downturn has been so prolonged that I think this mindset of diversification and sort of risk reduction has sort of finally ingrained into some investors' mind. I'd say we always say individual investors particularly have the memory of like a goldfish. So a lot of times, yes, we're seeing more interest back into Hong Kong, China market given the rebound. But I think because they've been quote-unquote hurt so many times in the past 2-3 years, that I think for a lot of investors, particularly those looking at wealth preservation, not necessarily, I need to look for my next 10 million, 20 million. They are really focused on risk management as well as diversification. And we've also seen sort of in the past 2-3 years a lot of black swan events. Large private banks could go bust, geopolitical risk. So I think it feels quite different. If you asked me previously, I would say, maybe people might pile back into high risk again. But I think this downturn is long enough to kind of ingrain this into some investors' mind.
All right, Steffanie, great stuff. Thanks so much for bringing that report to us. Steffanie Yuen, Managing Director and Head of Hong Kong at Endowus. And of course, if you are a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can join the conversation, send us instant messages, questions to our team and guests throughout our live shows as well. Check it out at TV Go. This is Bloomberg.
right, this big deal, no more. The BHP Group walking away from its battle to acquire Anglo American in what would have been the biggest mining deal in over a decade here, in a decade, roughly speaking there. Let's get the details on the story. Martin Ritchie joins us right now. Martin, why did they walk away?
Yeah, 5 weeks since the news broke that they were going to try and create this biggest mining deal in over a decade. BHP CEO Mike Henry did finally have to walk away. Look, the reason is pretty simple. That there was just no appetite on the Anglo side to engage with BHP. BHP management made an initial informal offer, raised their bid, raised it again yesterday before the final deadline in the UK for them to make a formal bid. They set out a whole document outlining what remedies they have for some of Anglo's concerns. Still wasn't enough for Anglo to even engage in any concrete way, so BHP said, okay, we're not going to go ahead with this.
So where does this leave both these companies now, Martin? Obviously, BHP, Mike Henry, he still wants to look for those copper assets. Where else can he find it?
Yeah, so as we've said all along, the main motivation for this was to get at Anglo's copper mines, mostly in South America, very high quality assets. BHP CEO Mike Henry has long said the company wants to focus on expanding its copper business. This would have been a huge transaction towards doing that. Now, it has to look at other options. There aren't that many options in terms of expanding in copper. It could potentially consider coming back to another effort to buy Anglo later on. Has to wait another 6 months, or it could wait until Anglo has gone ahead with its big restructuring of its own, come back again. But then the problem with that is it might face competition. Once Anglo has slimmed down, you could see companies like Glencore, like Rio Tinto, like others come in and compete with BHP for those assets.
All right. We'll see how things go in 6 months. Martin Ritchie, thank you. Our commodities reporter joining us out of Shanghai there. Another story, we're focusing on oil markets as well now when it comes to what Bloomberg has been learning, that Saudi Arabia is preparing to formally launch a secondary offering of shares in oil giant Saudi Aramco as soon as Sunday. Now, sources say the share sale could raise over $10 billion. Listen to our Asia oil trading reporter, Elizabeth Lowe. She's on the line with us right now. Elizabeth, maybe tell us, what's the likely implications for the market?
Yes, so this latest development is coming almost 5 years after Saudi Arabia raised around $30 billion for Aramco's IPO, which was the world's biggest IPO. And it looked like another round of funds. So these proceeds from the share sale are expected to go into initiatives that will help to take the Saudi Arabia economy away from crude oil into other investments such as artificial intelligence, sports, tourism, and projects such as the massive $1.5 trillion NEOM. I think it's also coming at a time Aramco's share price has been under some pressure from OPEC Plus oil production curbs. But still, analysts are placing Aramco stock at a premium to other international energy firms. So it's definitely a big development everybody will be watching.
Speaking of development here, Marathon Oil is being bought out. Tell us by who, tell us by how much, and what that means for the wider sector here, Liz.
Yeah, so another pretty big deal. We've seen ConocoPhillips acquiring Marathon Oil in a $17 billion deal. So this deal will expand ConocoPhillips' footprint in domestic shale fields from Texas all the way to North Dakota, and gives it reserves as far as Equatorial Guinea. So when it's combined with Marathon, it will have around 2,000 locations where it can go back into older shale wells and frack them again with new techniques that will help it to tap more hydrocarbons. So it does look like a trend that's been happening where we've seen other similar deals by oil producers in a bid to gain more drilling sites. It does look like more companies are betting that oil and gas demand is going to remain robust for longer than previously expected.
Liz, thank you so much. Elizabeth Lowe there, our Asia oil trading reporter on just the latest here. So this massive share sale that's about to come in, of course, this deal, $17 billion there. Right, oil prices flat. Looking at my screens right now. Plenty more ahead. This is Bloomberg.
Well, here's your China brief this morning. A look at what's making headlines in national newspapers this morning. And Shanghai Securities News is reporting that authorities are looking to gradually lift purchase restrictions on new energy vehicles across regions. Now, that's according to their latest carbon reduction plan, which focuses on areas such as energy, industry, and transportation. There's another article out there that says that China's housing market is heating up since authorities rolled out a broad rescue package for the sector 2 weeks ago. The report says over 70 cities have introduced similar policies, including Guangzhou, Nanjing, and Shanghai. But the piece also sees some challenges on the horizon, including the financial burdens for some of these SOEs as they look to large-scale acquisitions.
Yep. Now, China's English language media are highlighting the State Council's report. A lot of details on this one, but effectively criticizing the U.S. and their human rights record there. Now, the report cites things like alleged racism, gun violence, political polarization as human rights violations there in America. Now, China has long pushed for its own definition of human rights and has been, of course, growing its influence in the Yuen Human Rights Council. For more context on this report, which, by the way, comes out annually here, Stephen Engel, our Chief North Asia correspondent, is here with us. What is China trying to achieve? What's the answer to the big picture question?
Yeah, look, I mean, it's easy for me to come out here and maybe say, that's the pot calling the kettle black. But I look at these very separately, right? China can level these allegations against the United States, whether it's society or the police brutality or the border crisis or the drug problems. They can do that. And the United States has leveled many allegations against China, okay? I think the merits of such arguments stand on their own. So we can't say, well, China does this. How can they be doing a double standard by saying this? So let me just put that disclaimer out there. The fact is, and I've read through the extract of this, basically it was 35 or 30 pages of allegations about the United States saying, while a ruling minority in the United States holds political, economic, and social dominance, the majority of the ordinary people in the U.S. are increasingly marginalized, with their basic rights and freedoms being disregarded. Well, okay, that might be true, but put some attribution to this as well. I call on the State Council to do that. The U.S. is what it is, warts and all. It's an open book. A democracy is an open book. And social media and media is an open book. It's not censored necessarily. There's polarization in the U.S. media, obviously. And, human nature to take numbers that fit their narrative. And that's what essentially Beijing is doing. They're looking at the societal ills in the United States and using it for their own propaganda. That's just basic knowledge. That's what they're obviously doing. Now, in the U.S., this report says human rights is essentially a privilege enjoyed by only a few. But again, what's a few? Where's the attribution? That's my only criticism of this report. Because again, here's the last sentence that I will highlight. Nearly 3/4 of Chinese Americans had experienced racial discrimination in the past year. 55% feared hate crimes or harassment would jeopardize their personal safety. That means 5.4 million Chinese Americans in America. That means 4 million. Again, they're not attributing any of this data to any survey or anything. So you have to take these kind of things a little bit with a grain of salt, but also understand there are problems in the United States, for sure.
There we go. Steve, thank you so much. Stephen Engel, our Chief North Asia correspondent here. Just back to markets. So a couple of things here. So the Chinese chip stocks are rallying, and it might be on the back of this sort of development yesterday where you have Samsung, of course, and the labor there, of course, and union. The union is planning that first strike, of course. Just keep that in mind. Broadly speaking, though, so you're looking at yields as well here. This melt-up continues across the region. We did get the details on the budget this hour out of New Zealand, so the bond bleed continues and goes into the rest of the region where you are seeing effectively most of these assets are in the red. The risk assets, to be more specific, are in the red today.
Yeah, and it's interesting, right? We're just on the eve of that Fed PCE inflation gauge, right? So, does this actually continue? Or, if we see a softer print, is that going to relieve some of the pain that we're seeing across these sovereign bond markets here? But yeah, you're seeing the pain across multiple asset classes here today, whether it's stocks. To take a look at how Japan's doing, we're down 1.5%. And even when it comes to commodities, with iron ore in Singapore down some 2%. That's it for us here at the China Show.